Living a life in full is a conversation you always wanted to have with that person who gave an amazing TED Talk, or the author of one of your favorite books, or that inspirational Olympian you always wanted to know more about. It's graduate-level conversations with those making a difference in the world and in the lives of others. This show brings you new ideas and approaches so that you can live a life in full. I'm your host, Dr. Chris Stout, and I hope you enjoy this episode. This episode is brought to you by the nonprofit I founded, the Center for Global Initiatives. The Center is an all-volunteer organization, so there are no salaries, and thus all tax-deductible donations can go to the work. While our key country partner is in Tanzania, our work is global and generally focused in the areas of education and healthcare. We also help others to get their nonprofits started or augment others' project-based initiatives. It's our goal to open-source humanitarian intervention and to help make it easier for others to do more good in the world. We are proud to have been ranked a great nonprofit every year since 2011 and to have achieved a platinum-level rating by GuideStar. Links in this episode's show notes will take you to published articles on our outcomes, a number of helpful tools, and downloadable resources, which are all free, always. Please visit us at centerforglobalinitiatives.org and be sure to watch our video at patreon.com/Dr. Chris Stout to learn more. Thanks. Welcome to another episode of Living a Life in Full. I'm your host, Dr. Chris Stout. Investment research created by large banks, mid-sized banks, and even small boutiques is frequently muddled by conflicts of interests, and its value diminished by over-distribution. Analysts often feel pressure to have positive ratings to support bankers or to generate corporate access. And the time horizon of most research is typically very short, causing analysts to miss long-term winners due to near-term considerations. But the biggest issue is that most analysts have no proprietary information or process. Additionally, what are the mental models that can best serve not only making investment decisions, but also the various other choices we make in our lives? John Zolidis has a lot to say about all that. As to the investment aspects, via Quo Vadis Capital, where he is president and founder, he provides a research service that, while designed for the buy side, is organized to solve for the sell side's issues. If you're not exactly sure what that means, we'll unpack all that and more in this conversation. John's work has appeared in the Wall Street Journal, Forbes, Fortune, the New York Post, MarketWatch.com, TheStreet.com, and others. He was named in the Wall Street Journal's Best on the Street list and is a part of the value investing conferences in Vail, Cyprus, Cloisters, London, and Dubai. Before John started his career in finance, he attended Kenyon College and later Oxford University, where he studied philosophy and German. John currently lives and works from New York and Paris. Please note, before John and I get started, in this episode we are not providing any investment instruction or recommendations. Please consult your financial advisor for investment advice that's appropriate for your personal financial situation, risk tolerance, and objectives. Now, John, welcome to the show.
Thanks so much for having me.
Good to have you. So I think we have Guy Spire to thank for introducing us. How did you guys first connect?
It's a long and circuitous story.
Okay.
But it starts with Vitaly Knedlikson, I hope I'm pronouncing his name right, who works and lives out of Denver. And Vitaly had been for many years writing articles, talking about value investing. And I believe at some point my interest was piqued in something he was doing, and I sent him a piece of research that I had published for my professional investor clients, suggesting that this particular company, which was Finish Line, a footwear retailer, was very interesting from a value investing perspective. Vitaly bought the stock, made money, and said that this was the first time he'd ever listened to a sell-side analyst. He subsequently invited me to his conference, Value X Fail, which I attended for the first time in 2016. Uh-huh. And this conference was in turn inspired by Guy Spire. And ultimately, through that particular introduction, I eventually received an invitation to attend Guy's conference, which I think I did for the first time in 2018.
Uh-huh.
And then I believe after that, Guy did a podcast with me. Actually, that's actually a pretty funny story. So he had invited some YouTube experts to his conference, in addition to investors and other assorted professionals and individuals. And the YouTube investor was talking about or the YouTube producer was talking about why YouTube was such a successful platform, why it was so much more interesting than some of the other social media platforms. And the main reason is that the content on YouTube never dies. So when you look at something posted on Facebook or Instagram or LinkedIn, these things, or Twitter, if you will, these things get buried quite quickly. The posts get buried, they go stale, they get lost, they're never seen again.
Mm-hmm.
But something that's on YouTube, because of the searching related nature of it, it continues to kind of be relevant and continue to show up and can actually kind of get resurrected at some point in the future.
Mm-hmm.
So when I was talking to Guy about my business and I was looking to find and touch more people and get more individuals involved and have more people read my newsletter, he suggested doing a YouTube video. Initially, I was concerned about the compliance-related elements of that because with all things within the finance industry, the first thought is how is this going to get me into trouble?
Sure.
But eventually, what he said, he provided this, I think, like actually really great advice. He said, "John, have the courage to suck." That's what he said. So
It sounds like
said,
him.
okay, fine. So let me go on and I will just put on a video. And actually he said, well, look, before you do that yourself, why don't we do a video? And so he called me on his show. He has his own podcast. And he said, look, I'm just going to pull a presentation off your website. I know you have compliance related concerns, so let's just pull this presentation from 4 years ago. Here's a presentation from 4 years ago. It's about Starbucks and China and Starbucks growth in China. And let's just walk through the presentation. So he walked through the presentation, asked questions. We looked at some of the charts. We talked about why Starbucks was interesting. We talked about why China was interesting. And then he put it up on his channel. And he was able to get, I don't know how many thousands of views relatively quickly. And the point was, this demonstrates the power of the platform. Now we've seen a way we can do this. It doesn't matter. It doesn't have to be incredibly well rehearsed. It just has to be interesting content. And we're going to leverage the power of this platform. We're going to make the platform work for us rather than the other way around. And I think that series of events eventually led you to me through one of Guy's tweets or other emissions.
Wow. Yeah, Guy is kind of the Kevin Bacon of the financial world, because he's also connected me up with a number of other folks. And I think we were at Berkshire Hathaway together a few years ago, just sort of coincidentally. My daughter was there with me, and I saw him at the airport and stuff. He's really he's quite generous with things. I have plagiarized one of his phrases quite frequently with I guess attributions. I don't know if that's exactly plagiarism, but that he likes to learn in public, and I think he really does kind of put that into play with what he did with you on YouTube and with what he does with others on his podcast and stuff. So that's great. Well, and I have, you and I were talking off mic before we started. This is kind of a magazine style show. Every episode's, kind of a variation on, different kinds of folks and interests and things like that. And I guess, for me, with the area that you're in, I've had guests on early financial independence, medical startup investing, private equity, tech investing, general startups, and even financial journalists. One of the authors that worked with Guy for his book on kind of his bio / value investing. So having you on the show is just, really terrific. I want to go back maybe into your origin story. I know that when you were younger, you wanted to be a professor and you really had zero interest in business, and you were going to get a PhD in philosophy of language and philosophy of mind. You'd gotten accepted into graduate school. What was the pivot? What changed that we aren't discussing philosophy of mind and we're discussing value investing?
Well, you're absolutely right. I had zero interest in business. I grew up in a small town in Wisconsin. I didn't see my parents' friends going off to work in business in the morning. I'm not saying that I came from some kind of disadvantaged background, but there just wasn't there wasn't exposure to that world where I grew up, and certainly nobody was going off to get internships through their connected parents or relatives or what have you in Wisconsin. I kind of thought I was interested at a young age of philosophy, and without getting into all of that, I had moved to New York City to do a PhD in philosophy, specializing, as you mentioned, in philosophy of language and philosophy of mind, which is sometimes called philosophy of psychology. And I had started there, and I think there were three considerations that led me to pivot, as you put it. The first one is that it takes a really long time to get a PhD. It could take,
Yeah, and it's not cheap either.
I mean, 6 to 8 years. Yeah, New York City is not really the most ideal place to be a graduate student.
Right.
Yeah, your friends are investment bankers and they're going off to expensive clubs, and meanwhile, you're hoping to get cheap coffee and you're trying to study in an apartment with thin walls where all of the noise is coming through. That's not so great either.
Yeah.
In addition to that, however, one challenge with philosophy as a discipline, and when I say philosophy, I'm talking about the analytic school of philosophy, which is to be distinguished from the continental school. The continental school being the kind done in France and Germany, that being the continent. The analytic school is done in the UK and in the US. And the analytic school is very rigorous from a thinking perspective, and your tool is language. So if you spend 8 hours in a day thinking very deeply about the relationship between words and the structure of your sentences, once you finish doing that, you can't really turn it off. So when you start to speak to, regular people who are not really that concerned with the exact reference or utilization of the words that they're putting into sentences, you find yourself mentally dissecting their ordinary speech in a way that leads you to be, really annoying. So I think that's something you want to avoid. So one, it takes for a really long time. Two, I think it does some, unattractive things to the way that you think about the world and interact with others. And then three, and this was the last piece, the most important one, I think that really drove me away from it, is the inability to choose where you're going to live. So when you graduate with a PhD in philosophy, you're kind of at the mercy of which jobs are available that year. There may not be that many jobs available, and they may be in places that you don't really want to live.
Right.
And so I was kind of focused on my own lifestyle from the perspective that I wanted to live in an interesting place. And I didn't like that I wouldn't necessarily be able to choose where I might live. So those are the three things that were happening. Situationally, when I moved to New York, I started working as a temp, getting office work, which was something that I could do while pursuing my PhD. And I had several jobs in the World Trade Center, answering the phone and doing various things. So when I decided that I wanted to press pause on the philosophy graduate school, I networked internally in the World Trade Center, and I found a job working in the corporate library at Dean Winter Reynolds, which was later acquired by Morgan Stanley or merged with Morgan Stanley. And my job was to aid research analysts to do something which was called researching defunct securities that people would send in to us, which is an interesting topic. And then lastly, fixing their computer systems, because at this time, basically any college kid could fix computer systems of major corporations. And, people are very excited when you could do that sort of thing. So I was doing that. And so decided to try to to move from that not even entry-level job into something more permanent within that structure, because there was the opportunity.
Mm-hmm. And give us a timeline for this. This is obviously before the World Trade Center was struck. When was this, mid-90s, or when were you there?
So I moved to New York City in 1996,
Okay.
and I worked in the I ended up working in the World Trade Center for about 3 years, I think, from till 99, like 96 to 99, I was in there.
Gotcha. So for these defunct companies that you're talking about, were these ones that just went bankrupt, and you were doing kind of a postmortem on them, or what was that?
So I was not doing any kind of postmortem. The department was amusingly called statistics, even though, as far as I could tell, we weren't doing anything of any statistical nature whatsoever. So what would happen is that someone would find a stock certificate in their attic, or they would inherit it from their aunt. And it would be, 100 shares of the Pennsylvania East-West Railroad Company from 1932. And they would say, I wonder if this has any value.
Wow.
And so what they would do is they would go to their Dean Witter retail broker and they'd say, look, I have this stock certificate. Is this worth anything? And that guy would say, or gal would say, I have absolutely no idea. But there's a department called statistics, and I will fax it in. So they would fax us the stock certificate.
Wow.
And we would then take the stock, and then we would have to look it up. So we'd have to figure out, we would research it, what happened to the company. And so what that involved was very sophisticated analysis. We would refer to a series of almanacs, and we would look it up. And
wow.
we would find out that the Pennsylvania East-West Railroad Company of 1931 had been acquired in 1932 by the North Dakota Trading and Import Co. for, I don't know, $17 a share. Wow. And then we would see what happened to the North Dakota Trading and Import Co. business, which typically was merged with another business at some other time later, which would then go for a 10-for-1 reverse split, eventually filing for bankruptcy in 1939, shares being worthless.
Wow.
So we would write down all of this history, declaring what had happened to the shares and all the stock splits, et cetera, mergers, acquisitions. And then we would type up, I was asked to type up what we call a wire, which was some kind of archaic internal communication system. And I think they chose me to do it because I could type. And I would send this back to the broker, who would then inform their client that the stock certificate that they found in their aunt's attic was in fact worthless.
Wow.
And I think the funny thing is that the interesting thing here is actually to ask, why did these stock certificates never get thrown away?
Mm-hmm.
And I believe the answer is, it was a feature of loss aversion, right? If you didn't throw it away, there was some chance that maybe it could be resurrected, or maybe it would be have some residual value someday.
Yeah.
But just a lot of these things lying around, and people, it's just like, why do people hold on to stocks that have gone down a ton? They just don't want to admit that they're worthless by selling them. And it's a similar thing, except with physical certificates.
Right. Yeah, it's a very interesting parallel. The whole, it's going to come back, or, and even it's an interesting thing, the abstraction of looking at, like a number on your phone or on your desktop versus the physicality of a paper certificate that, just has to be worth something because it's tangible and I can hold on to it, or, Aunt Gertrude, held on to it and thought, it was the best thing in the world. Wow. That's great. You're kind of like a forensic analyst, back then. So I don't know if maybe this is the roots, but I know today that I think I know, so correct me if this is wrong, that your process is really rooted in a proprietary approach that you've developed based on all these great skill sets of forensic analysis of dead certificates. But you have a really impressive track record. And I believe you conduct single stock research for professional money manager clients that would be mutual funds or pension funds or hedge funds. And you also do it for individual investors, where you do investment management services with primarily equity and common stock portfolios. And you're obviously a registered investment advisor. For me, very few people know that for about 2 years in the late 90s, I was a registered investment advisor myself. I ran a website called Smart Wealth, and just kind of worked as a kind of a Mr. Magoo momentum trader. So I'm curious, how did you make the transition? We haven't talked really about Buckingham Research, but how did you make the transition from Buckingham Research to being a founder of Quo Vadis Capital?
Okay, great question. Thank you. So I had worked for, so we fast forward from the original statistics job. I found a job as an equity analyst, worked for 2 years for a gentleman called Peter Sidoti, researching microcap companies, which was a really great experience. And then I transitioned over to Buckingham Research, and I believe I was a equity analyst there for maybe 15 years before spending some time working on their internal hedge fund. We had about $900 million, and of that, there were two funds while I was there, and one of them was a sector-specific fund focused on retail apparel and footwear companies. That didn't last too long. I tried to reinvent myself as a restaurant analyst back at Buckingham Research, but at that point I felt that the writing was on the wall for the business. And so the question was, how do I control my own destiny here? So what should I do? How do I monetize my skill set? And I felt that there was a need for real research, but that few were doing research in a way that was oriented to what the clients, that is professional investors, buy-side analysts, investors, and portfolio managers, really needed and wanted to. And then secondly, over the years at various times, people had asked me if I could manage some money for them. And in the previous structure as a broker-dealer and an equity analyst at broker-dealer, that was not allowed. So I felt that I could set up my business as a registered investment advisor, which would provide me with regulatory oversight and allow me to manage money for individuals, but also to create research in a way that evaded a lot of the industry structures and problems that you alluded to in your introduction, and I could sell it directly to my clients. So that's kind of the shorter answer of what I was thinking and why I decided to go out on my own.
So did you fund that? Like, was your stake to do this as starting up by virtue of those individuals that wanted to use you as an advisor, or how'd you get your stake to get the show on the road?
Well, the great news is you don't need a lot of money to set up a registered investment advisor. I mean, it's a few small fees. You have to pass some regulatory exams. There's no capital requirements.
Okay.
It's not like setting up a broker-dealer or a hedge fund that you have a big structure. And the research needed a compliance background. I needed some access to a Bloomberg, or I use FactSet. So there wasn't really a lot of capital required, other than just to fund myself while I was trying to build up a sufficient amount of clients to generate an acceptable amount of revenue.
Got it. So I started off too in the introduction where we talked about used terms like buy side and sell side. And at Buckingham, I've read that you saw flaws in the sell side research. Can you talk about what's the difference between buy side and sell side for those that don't know, and what were the flaws that you saw on the sell side at Buckingham?
So sell side research is typically created by investment banks, and it is sold to professional investors who are managing money for others. the buy side are the analysts and portfolio managers that work at hedge funds, mutual funds, pension funds, that get research from outside sources that they incorporate into their process of making decisions of buying and selling stocks, or increasing or decreasing their market exposure, or shifting from one sector allocation to another sector allocation based on what they think might be happening in the future.
Okay.
So the sell side piece are creating this research, the buy side are consuming it. Those are what's behind the two different names. When I talk about what was problematic from a sell side perspective, it was definitely not specific to Buckingham. There are a number of industry issues in my mind that inhibit sell side research from creating a lot of value. And I want to definitely add that there are many very good and talented sell-side analysts out there, some of whom create really great research and that I still read occasionally. But the vast majority of the research is hamstrung by a number of different factors. So the first one is regulatory related. So there's something called what is a research report. And there are certain things that must be included in a research report. And there are certain kinds of language you can use and certain kinds of language you cannot use. And so what happens is that right away, before an analyst goes to create anything, they're already hammered into a format which is preconditioned and created by regulatory agencies, not with the interest of the client in mind. Secondly, there are things like the distribution of your research, which needs to go to a broad group of clients if there are any specific changes that you make. So if you change your estimates, your price target, or your rating, you must distribute it simultaneously to all clients. And this has the perverse effect of causing analysts to not change their estimates, because if you do change your estimate, you must publish a note. And so nobody wants to publish a note saying that their estimate went up by 5 cents because interest rates changed or something like that. So estimates tend to get stale. Third, so as I said, Buckingham, for example, we had roughly 2,000 clients on our distribution list. So let's say you are a sell-side analyst and you do some really exciting, unique research and you come up with some insights that nobody else has ever seen before. And this is really great. You want to show it to your clients. So it gets published. It goes to 2,000 clients. Well, let's say only 10% of those clients really would care anyway. So 200, and only half of them actually read it. Well, still, that's 100 professional investors reading your research. And in that scenario, the special insight that you have created after many hours or weeks of laborious work has now been consumed and can literally be like instantly reflected in the stock price.
Wow.
So you basically discounted whatever value created is like evaporates almost immediately by the way that you distribute it to your clients.
Wow.
And then, the other issues that you mentioned, I think are bigger, which is you need to keep these very positive relationships with the management teams, because you need the management teams for various things. You need them to come to your conferences. You need them to answer the phone when you call them. You want to be included on the conference call. So it's a very big prohibition, a very, very big penalty for saying anything that's not favorable.
Wow.
So you're kind of forced into a very bland language where you have to be very cautious about what you say. You also could upset one of your clients. An important client may be upset if you think that their favorite position is a sell, and then they'll cut you off.
Wow.
And then the salesperson won't pay you. So there's this conflict of interest swirling around everything that you're doing, which inhibits you from really stating what your opinion might be about the company. So you're constantly kind of backtracking and thinking about how you might offend some party in the value chain, which is going to negatively affect your compensation.
Wow.
So that is a big issue. And then lastly, the thing that I mentioned and that you read was the lack of proprietary process or information. So I think the vast majority of sell-side reports are simply earnings previews or reviews saying, hey, this is what we expect the quarter to be. And then the quarter comes out and then they just rehash what was in the quarter. Meanwhile, all the clients have already read that. They have zero interest in hearing an analyst repeat what was in the press release.
Wow.
And they don't really have an edge kind of forecasting the business. They don't have any special information. I mean, some do, but for the most part, it's very difficult to get those kind of edges and then have them on a repeated basis sustainably over time. And then to kind of distribute it in a way that doesn't affect the embedded expectations in the stock price. So I think with that, I'm kind of giving you a window into all of the challenges that surround the production, the distribution, and the monetization of research that makes it really hard for it to have value.
And it must be so frustrating as being that analyst, feeling like, you've got to just, like I could see doing all this research. And sometimes this happens in medical and psychological studies too, what they call the file drawer effect, which is that, you do a study or something and you don't get the outcome that you thought. So you think it's not going to be able to be published in a scientific, journal and help you out with your, getting tenure or something. So you just, put it in the file drawer and it never sees the light of day. I would imagine that with all these, competing interests, that there's quite the, that influencing an analyst saying, well, maybe I, shouldn't say this, or maybe I shouldn't be as full-throated about it as would be accurate. That just seems like such a darned if you do, darned if you don't kind of situation.
You could say that, but on the other hand, I would say a lot of equity analysts get paid quite well, so they can live with it. Look, it's a demanding job. You need to be in the office at 7 a.m. You could be there till 7, 8 p.m. You're traveling quite frequently. It's competitive, and there's a lot of demands. You have to produce a lot of product, but generally speaking, it is a fairly highly compensated position.
Gotcha. So shifting from that, just before we get into some of your like rating systems and talking a little bit more about value investing, just one other question about Quo Vadis. Like from the operations side, are you subscription based or how do you get compensated? How does it work for you so that things are tidy and following within regulatory guidelines and things like that?
Sure. So I have two lines of business, as you pointed out. So one is the registered investment advisor, where I'm managing money for individuals, and in that I charge a flat fee, and that's basically similar to what all advisors charge. So sure. It's around 1%, a little bit or a little bit less. And the other business, the research business, is on a subscription basis, and I set it up that way because I want to be freed to spend as much of my time as possible researching interesting things that can help my clients make money, rather than calling them to put on trades, which would be not in their best interest.
Yeah.
So that's why I set it up with it as a subscription basis.
That's great. I like that. I know with Guy, speaking of him, with his firm Aquamarine Capital, he's deep in the Munger Buffett camp vis-a-vis value investing. And value investing is really kind of your niche too. Is that correct?
I think value investing has a lot of interesting and attractive properties, and I think all investing is value investing at a certain level. There are different species of value investors.
Okay.
So, and some of which I find difficult to execute or not particularly feasible, at least for me.
Okay.
So some of those, so we can go, for example, the classic is like the cigar butt investing. And so this is an analogy to that Warren Buffett created, which is, hey, sometimes you can walk down the street and you can see a cigar butt that someone has just tossed out, but it still has a few puffs in it. And if you could just pick it up and scoop up those puffs, you get them for free. And so what he's saying is like, hey, sometimes there's these like thrown out stocks that have, they're a melting ice cube, but you can buy them below the value of the melt, if you will, to mix metaphors. I find this like a very difficult way to invest. And that is also something that I think has become more difficult because of quantitative screens. Mm-hmm. So it's easier for computers to find these cigar butts, if you will, than it may have been 40 years ago when Warren Buffett had coined the term, if maybe it was even further back than that. There are other guys, like say if we take Seth Klarman, who wrote the book Margin of Safety. He's very interested in finding businesses in very hidden pockets of the market that are not well followed or that are ignored by other investors, and they're trading at a substantial discount to what he believes their intrinsic value might be. Mm-hmm. I also think this is quite difficult because one, you need to be a generalist because these opportunities they're kind of distributed broadly across all sectors. Mm-hmm. Two, you have to be extremely patient to find them. And then three, and this is the hardest part in my mind, is that you need to sell those if they go up. So in the event that you find something that is significantly below its intrinsic value, if something happens and the happy occurrence happens and it goes up for some reason, then you need to sell your position because it no longer has this margin of safety built into it, and then you have to reinvest those proceeds into some other crazy, difficult to analyze, hard to locate business that's not similar to other things that you already know. So some people are really good at that, but that is very difficult.
So you could be sitting on the sideline with cash, just waiting for that next opportunity that may or may not come in any time soon.
It's also tax inefficient because you've taken profit a lot.
Yeah. Good. Yeah. Wow.
If you look at Howard Marks, he talks about being very attuned to the investment cycle and making sure that he's buying at times when stocks are extra attractive. But these cycles can last, 8, 12 years. So again, very difficult to have a career or as a professional investor when you're mostly sitting on your hands. So my approach is to look for higher quality companies and to try to buy them at a discount.
Okay.
And I think that that's been a little bit more of the Warren Buffett together with Charlie Munger approach, has been more focused on quality. Buffett likes to talk about moats, positioning, and if we take, for example, Apple, which I think is Buffett's largest holding, he may have bought it at a discount, but certainly there's been times in the last several years or decades since he originally bought it that Apple has not been trading at a discount. I believe I read I saw an interview with him where he was asked about his position in Coca-Cola. This was decades ago, and it had gone up quite a lot. And he said, well, Coca-Cola is a wonderful business, and there are not that many wonderful businesses. And so, I don't want to sell it, even if I believe that it's not at a substantial discount to what intrinsic value might be on a near-term basis. And so I'm a little bit more in that camp, which is trying to find really great companies, buy them at a discount, own them for really long periods. It's much more tax efficient. And then my institutional knowledge of the business increases. So as I've owned the same companies for years and years or decades, my comfort level with the businesses increases, my depth of knowledge of the businesses increases, and I'm less likely to be shaken out in some kind of a market dislocation. And I think as an individual investor, that's the biggest risk, is that you sell when things seem really scary, and you find yourself chasing when stocks are going up. So if you take a really long-term approach, really get to know the companies you own quite well, and don't get too caught up in worrying about on a short-term basis whether they are overvalued or undervalued relative to near-term cash flows, I think you can avoid a lot of mistakes.
What then makes the indication for a sell? And do you just sell like a portion just to be able to have that liquidity to then live off of, so to speak, or to be able to use that for something else that looks interesting to invest in, or what? I totally get that philosophy of the buy and hold. I also, it seems like Munger and Buffett are also will sit on stuff. I mean, I remember a couple of years ago, if memory serves, that they weren't buying anything, and everybody's like, "Oh, come on, you can't just sit there." And they said, "Well, sure, we can just sit here." So, how does it? What for a situation where you've got a good business, a good company, things are going well, what is the trigger to sell some of it or to change a position?
So I recently gave a talk at Columbia Business School about this, about what the sell discipline is, like when do you sell?
Mm-hmm.
And so I outlined a few different criteria. So the first one is when you've been wrong. If you buy something because you think it's a great business and they're going to grow earnings and management team's fantastic and you think the stock price is excellent and they've got competitive, and it turns out you were just wrong, usually that is telegraphed to you by the fact the stock's down a lot, but the fundamentals are not what you thought they were. You need to recognize that and sell and move on. So I mean, that is, as an investor, you're going to be wrong a lot. So
Sure.
that you just have to know when to move on. So that's number one.
Uh-huh.
Number two, I mean, you could sell in a scenario where you think a business has just become, stupidly overvalued. Now that's a little bit trickier. Like, how do you define stupidly overvalued versus just sort of overvalued? I tend to stick with them even when that happens. Maybe it's an error. And a third reason is when you find something better. So, and that could be a better company, something that's earlier in its growth curve, something that's cheaper relative to its intrinsic value, because starting with the assumption that everyone has a finite amount of capital to put to work.
Right.
So ideally, you want to be managing their portfolio relative to the opportunities that you see in the market and the businesses that you find most attractive at any given moment. So those are the things that I talked about in the Columbia talk together with short selling.
That's good. And speaking of that, I want to get into short selling with you in just a second, in particular your Dubai talk on it. But before we shift into that, just because I'm curious too, do you have some tips or techniques about ways to manage risk of, those? Because I know, like, a lot of times people fall in love with companies, they fall in love with the story, they fall in love with the founder, they fall in love that they had a big run up and they expect it to, just keep going straight up and hockey stick forever. So what are some of the ways that you mitigate or manage risk in your investment decision making?
So risk is a tricky concept, and it's also a concept that's similar to uncertainty, which I tried to talk about in Vail, and I found was based on the reaction or diverse reaction that I've gotten to that talk is something I think is just not particularly well-defined concept. But as far as managing risk, my approach is threefold. So first, one is to really do a lot of work. So make sure you really understand the company well that you're investing in. Now, maybe this isn't possible for individual investors, but that's the first piece, is to really understand the business well. The second piece is to take a very long-term orientation, because again, as I mentioned earlier, I think the biggest risk is to sell based on short-term problems in a business or short-term changes in the economy or short-term changes in what sectors people want to own, and move away from your focus on the company's long-term fundamental prospects, which is what you want to own it for. And the third is to make sure that you buy businesses that don't have impaired balance sheets. So own companies with strong free cash flows that aren't overly leveraged, so that if there's something really goes wrong with the market, the business doesn't go to zero. And of course, a really good recent example was COVID. Mm-hmm. Right. So you wanted to make sure that your business could survive a period where there was no revenues coming in for some short period of time or indeterminate period of time.
Gotcha. Good. Well, then let's use that as a segue to your Dubai talk. First of all, you use the Hindenburg image on the first slide of your PowerPoint. I also have to say, for folks, you need to go to YouTube. You need to look up, your PowerPoints and things. They're just really, I love your sense of humor with these, and so that's a little Easter egg people can look up and see. I'll put some of them in the show notes too. But on the cover slide was a picture of the Hindenburg blowing up, the blimp. And was that meant generally as a reference to being a disaster, hence, short selling, or was it to Hindenburg research?
It was not a reference to Hindenburg research.
Okay.
I have not ever read their research. I know they have a good reputation, but I have no comment on those guys.
Just curious about that. Okay, so let's discuss short selling and value investing. Some value investors believe that you really shouldn't be a short seller, and there's kind of a dogma about asymmetric risk and rewards in shorting, but I don't think that's your philosophy. Is that right? And if so, tell us why.
So, no, I do think that short selling can be interesting. It's not for everybody. It's different from long investing. And so in the Dubai talk, I wanted to first contrast one difference between how a value investor who's looking at ideas they want to own or be long would not have the same process as someone who's looking for stocks that they expect to go down. And the contrast that I called out is that when you're buying a stock that you think is trading below its intrinsic value, or that you think is going to be worth more in the future, you don't necessarily care why the market is providing you with the opportunity. It's not that important. What's more important is your analysis of the company's assets, its cash flow, its competitive position, its management team, relative to the price you're able to buy the stock. When you're a short seller, you actually need to try to disprove something about the reason that people own a stock. So you have to find something that's going to be different from what the street believes. Mm-hmm. So it adds this incremental piece of the analysis. So you don't just analyze the company and the stock price, you need to analyze what the market perceives about the business and then have a view as to why that's wrong. Because when the market realizes that it's wrong, that's when the stock price is going to be dislocated, theoretically go down, and then you will be able to buy the stock back at a profit.
Gotcha. So what are some of the ways that folks can get into trouble with trying to do that?
Well, I think the first thing that gets people into trouble short selling is that they try to short based on price or valuation alone. And that is usually a definite way to get into a world of pain. Mm-hmm. So, you need to have a view, like what is going to cause the stock to be reset at a lower price. If you just say, hey, this thing is crazily overvalued, there's no reason for it to trade at this. The problem is that stock prices can become detached from fundamentals, and they can become detached, and that can stay that way for a long period of time. And they can continue. And if a stock is irrationally priced at $100 a share, then there's in principle no reason why it can't trade at $200 a share. Mm-hmm. So I think starting with the frame that something is incorrectly priced in the market, and that is your main approach, is gonna lead you to be possibly covering at a higher price and losing money.
Gotcha. You mentioned like the aspect of COVID and the pandemic and how that affected at certainly a macro level. Scott Patterson has a new book out called Chaos Kings. I don't know if you're familiar with it. The subtitle is How Wall Street Traders Make Billions in the New Age of Crisis. And in that book, he talks about Nassim Nicholas Taleb, and famous for the Black Swan and Anti-Fragile, and Mark Spitznagel, I guess, was a student of his at some point in time. And they have, or Spitznagel has a Black Swan protection fund with his company Universa, and they have an audited 15-year annual return of over 100%, which seems crazy, but mostly, if not exclusively, by betting on calamities. Do you have any thoughts or opinions about that kind of an approach vis-a-vis shorting or that the unforeseen kinds of events that then they seem to feel are inevitable?
I mean, I think that Nicholas Taleb Tassim's book, Fooled by Randomness, is one of the most exciting books I've ever read as far as finance goes. And I really like the ideas that he has in those books about how our brains are programmed to find patterns in noise and then to try to ascribe a narrative and meaning to that when there really exists none. And the second point, or among the other points he has, is that people discount these very rare events. So you can buy insurance against those events at a much lower price than you should be able to, and therefore profit when these calamities or very unusual events occur. So, I mean, I think in principle, that makes a ton of sense. I think practically, very difficult to execute. I haven't audited their performance track record. I mean, it sounds, amazingly too good.
Unbelievable. I know.
So, I mean, the thing is, it's going to be very lumpy, right? A strategy like that, because calamities don't happen that frequently.
Yeah.
So you're going to have many years or periods where you just lose a little bit because your strategy isn't paying off and you have a carrying cost of running the business. And then whenever the calamity occurs, you make I don't know, some massive quantity, whereas everybody else with the opposite strategy is getting crushed. It's not something that individual investors can put into practice.
Yeah. It reminds me of like how VCs, if you look at like when you talked about the bumpiness, if the VCs have enough unicorns that go to $1 billion, it certainly makes their whole track record for all the the losers and stinkers that went bankrupt to become invisible. So one other question about that, then I want to get into your mental models. This also makes me think of like activist investors. We see the kinds of things that are occurring with Hindenburg and kind of what they're doing and what they've been doing. We see hedge fund managers like Bill Ackman or legendary short sellers and activist investor like Jim Chanos. How is that all within the crucible of short sellers, or is it being public about these kinds of things and sort of their I don't know if it's even paradoxically, but they're causally causing the shorts that they're calling to actually happen? Or do you have philosophies around that vis-a-vis ethics or practicalities?
Yes, there are kind of two different ways to talk about this. So one is there are people like Muddy Waters who do a lot of work. They put their position out there and then they go public with their thesis and their data, and I imagine profit from getting the market to come around to their view. And if as I said previously, you need a reason to believe that the market is going to view the stock differently, and you could theoretically be that catalyst, right? There's a lot of risk to that strategy, though. For example, if you're wrong. And unlike a long, and this is the second half of the answer to your question, when you're a short seller, it actually works against you to bring more people to your point of view. So if you, in the sense I mean that if you get if the stock gets crowded from a short selling perspective, you actually decrease the amount that you will make because the others will also try to cover the stock at the same time, creating buying pressure. And it also amplifies a negative reaction if you're wrong. So the more people that are short, if you're wrong, the more the stock's going to go up against you. So there's kind of those are the two schools of thought. One is like you put all your information out there, you can make the stock move all by yourself, and that's your strategy. A second is to really be quiet, and it's really only when there's a surprise that stock prices move dramatically. So if I take just one step back, I would say that when I approach investing for my professional clients, my first filter are earnings revisions. And I say that the most reliable predictor of stock price performance are changes in expectations for cash flow and earnings. So if you can find a business where people think that it's going to earn $1, but you think it's going to earn $2.50, it's highly likely the stock's going to go up when the earnings get reset to this higher expectation, and vice versa. If they're supposed to earn $1, but they're going to break even, it's probably going to go down quite considerably. So I spend nearly all of my time trying to find cases where analyst estimates, street company guidance, and street expectations are wrong, and I can have some conviction about which direction I think the earnings revisions are going to go.
Gotcha. That's great. So let's shift into, because I mean, this kind of the meta aspect of all of this conversation is your decision making and how you look at data and how you weigh it and whatnot. And I know that you and I were talking off mic before we got started with the Value X conferences. So I want to discuss your take on mental models and decision making. But before, for people that aren't familiar with Value X, can you share what that is, what that's about, where they happen?
So I think the value investing conferences are kind of a story that needs to be told. I don't think it's kind of a well-known thing. So, my background, even though I was working for a boutique investment research firm, was really within the New York City, Wall Street complex. And within that, the biggest sums of money in the hedge fund world are chasing a lot of fairly large, liquid public companies, and they're running strategies that require them to stay very close to short-term changes in performance of the business and the stock.
Okay.
So a way to say is something called market neutral. So when you're market neutral, you need to be long and short approximately the same amount of shares. And what these pools of capital are doing are trying to eke out, 1 percentage point of alpha per month. That would be the ideal situation. Mm-hmm. And so just 1% spread between their long and short performance while they're maintaining really no specific exposure to the overall market. And so to do this, these analysts and portfolio managers are extremely focused on short-term earnings revision trends in the quarters, and they're looking for cases where companies are going to beat or miss by small margins, and they can capture these small movements while not taking a lot of market exposure risk. And so they're just always focused on this news flow, the latest data, the near-term outlook, what management said at the last conference they were presenting at, et cetera. Mm-hmm. When you go to the value investing world, it's like an entirely different universe of thinking and approach. So generally speaking, the attendees at these conferences are not corporate. They're not coming from JP Morgan or Morgan Stanley or Goldman Sachs. They tend to be individuals. It's very entrepreneurial. Mm-hmm. It tends to be people running family offices, small funds, individuals managing their own pools of capital. And there's a very strong lifestyle element associated with the conferences. So the people who attend them are also interested in why they are investors as a profession and how they can live a balanced life, which is, not something that you hear frequently in the New York City complex of,
Right.
of short-term trading.
Right.
So, but I think it's worth it kind of just to talk about the format of these conferences a little bit. They're a user-generated content, which is to say that everyone who comes to the conference typically presents to the group. And so you have a peer, you have like a feeling that you're kind of all in it together, and you're presenting to your peers. So it's not a format where there's a number of high profile people presenting to an audience. It's a much more collaborative spirit. And then in addition to the presentations around investment ideas or investment philosophy or process from an investment standpoint, there's usually activities where the participants are encouraged to have conversations, do interesting things. So in closer Switzerland, you go skiing, you do snowshoeing. In Val, Colorado, we go to something called Camp Hale, which is an old military camp where they've got a whole bunch of fun activities. We go up the mountain, go hiking. This is in the summer. In Cyprus, we do a boat cruise. We visit some ancient ruins, and there's a lot of eating and drinking and socializing in addition to some actual work where we talk about investment ideas.
Nice.
So this kind of network helps you to meet people. You meet other people who are experts in different areas, and then you widen your network as an investor so that you can utilize the value and the expertise of all these different people when you come across new ideas.
That sounds great. How long are they? A week? A weekend?
Most of them are 2 to 3 days.
Okay.
I think that's about enough.
And how many folks attend these generally? I'm sure it varies, but on average.
They're each a little different. So Vitaly's is 40 people only. Sophocles, who runs the Cyprus Value Investor Conference, I think we're going to have around 60 there in September. The Dubai conference, I think, also had around 40 to 50. And Guy Spire's event in Cloisters has mushroomed a little bit recently. So I think it's maybe closer to 80 or 90.
Gotcha. So then with these, I remember way back when the TEDs first started with Richard Saul Wurman, he wanted them kind of confidential. Like, people, if you wanted to be at it, you needed to get invited to it. You needed to kind of, you could share with others what you talked about or whatever, but it wasn't as public as they are now with a TED.com, and people can watch TED Talks and all these kinds of things. You are very good about publicly sharing some of the things that you've given in talks. Is that a general value or a general ethos of the Value X conferences, that people then, if they choose to, can go out and share it? Or is it just kind of up to the individual that participates and puts something together? Or what's the norm for that, for these kinds of conferences in terms of public sharing?
So there's some important principles behind the conferences. So one of them is non-solicitation. So you're not intended to go there to sell to each other. You're going there to share. Nice. And provide value to the others. The second one, Guy Spire calls Gestalt. So, it's a positive, reinforcing type event. And then the privacy is actually a big component of it. So usually what's shared at the conference, the presentations are not allowed to be spoken about, or at least we ask people not to speak about them outside the context of the conference. That said, some presentations do get shared, and usually you can find, for example, on Vitaly's website, some presentations from past conferences with the permission of the attendees. So it is a little bit more buttoned up. They are, for the most part, are invitation only, or you have to be approved to attend. But but I wouldn't say that it's a kind of a snobby exclusive group. That's
Yeah,
not the idea. It's more of
right.
an inclusive group with the objective of kind of elevating the overall community um, by bringing diverse people together from different places.
That's great. I think that kind of additive nature of it and collaborative nature of it really, can be helpful in terms of growth and creativity and whatnot. So let's then take that in as our segue into mental models. Can you maybe to kick things off with a 101, how do you distinguish mental models from heuristics, or what are the differences in terms of what you see?
Sure. So I like to do process-oriented presentations. I don't mind also talking about individual companies, but more recently I've gotten interested in speaking about like, what are how to find good short selling opportunities, when to sell. And then I decided that I want to talk about mental models, and in particular, um, destructive mental models. So things that cause us to make error,
Uh-huh.
and then thus how to avoid them.
Okay.
So when I say mental model, this is not a term that I coined. It is a simplification. From an investment standpoint, it's a simplification of a process that helps you to more quickly absorb and understand a large amount of information.
Okay.
A heuristic, since you called that out, one of my favorite things to talk about is a mental shortcut. So a heuristic that I think is helps to describe this is the availability heuristic. So the availability heuristic is, if we ask you, for example, how likely is it for a pedestrian to be hit crossing the street in New York City? So you think, well, gee, I just think in my head, like, well, how many times have I read about that in the paper? Like, how available how hard is it for me to come up with an example? And if it's relatively easy, if I think of many examples, I think the probability is quite high. And if I can't think of any examples, I think probability is quite low. And this is a shortcut versus doing the actual work, right, of getting the data and synthesizing it and then calculating how many crossings per day there are in Manhattan relative to the number of hits that then you can get an actual probability number. So the heuristic gets you there more quickly, but it has the disadvantage of, in this case, perhaps being completely wrong.
Mm-hmm.
In the case of a mental model, it usually is trying to have some efficacious ability behind it. And so it does help you to, for example, like, I don't invest in companies with bad balance sheets, might be a mental model, very simplistically.
Mm-hmm. So, what are these destructive mental models? What causes investors' models to work for a while and then stop working? Is it environmental, or I think you talked about different factors of those. Can you maybe step us through those?
So I went through a couple of them. I'm going to start with the first one, which is to make me a little quiz. Okay, so everyone should kind of try to answer these questions for themselves. So, how many days does it take for the moon to circle the Earth? Chris, what do you think?
30?
27.
Okay.
27 days.
Okay.
Okay, how many days for Mars to circle the sun? 687. How about
That's what I was going to
Venus?
say. I was going to say that.
225 days. Um, and how many days does it take the Earth to circle the sun? 365. Okay, so here's the point of the quiz. What do these figures have in common?
With each other, or just they're
None of them, what they have in common is that none of them represent the ideal period to evaluate investment returns.
okay.
And so my point
Zero
is
correlation with. Got it. Got it.
that 365 days is not correlated to the economic cycle, and it's not correlated to the business cycle. So why do we look at 1 year performance returns? Why do you think about your portfolio in terms of a year-to-date performance? It's because of industry incentives. Salespeople need to sell funds.
Wow.
They need to have a increment of time that they can measure the performance so that they can put that in their sales literature. Um, that
Wow.
Wall Street banks pay on an annual bonus basis. So people orient their thinking to 1 year increment. But none of this has to do with like why you would buy a stock or sell a stock,
Wow.
in my opinion, why you
Sure.
should be buying.
Sure.
So that's
Yeah.
kind of the first point, is that there's this industry incentive structure and it gets you to think in a 1 year increment. And that's a source of investment error because it causes you to do things that you wouldn't do if you were to really to think about the right period for owning a stock.
Gotcha. Wow.
Um, and the second one has to do with the pattern-seeking nature of the brain, which you could also call the lizard brain.
Uh-huh.
And I call number two the wise man problem. And 2023 is a good example of this. So, ironically, the more experience you have and the more data that you've seen historically, the less likely you are to look for what's new and unique and different about these circumstances. So in 2023, many economists, actually the majority of economists, forecast recession. Now, this is an interesting point by itself because actually this has never happened before. It's never happened that economists as a group have forecasted a recession in advance. They have always waited for the recession to actually start. Like that's what the
Interesting. I'll
record
be
shows.
darned. Wow. Wow.
Why are they so convinced that there's a recession that's going to come? Well, you have an inverted yield curve and interest rates are going up and we're at full employment and whatever their reasonings might be.
Mm-hmm.
But thusly, I don't know what's going to happen the rest of the year, but so far they've been completely wrong. We have not had a recession. And so my point is that the reference to the prior experience is causing you to discount what's different about this time.
Interesting. It also calls into question the wisdom of the crowd, of the wise men experts, kind of problem. So I didn't realize that it was actually a phenomenon. That's good. Okay, good. Continue.
The third one I called analysis by analogy, or you could say false analog. And
Uh-huh.
this is more of something that happens, I think, for equity analysts. But when you see a new company for the first time, the first reaction that I have, and that I think most analysts would have, is how is this business similar to some other company that I already know? So you're trying to take a mental model of how does a restaurant business work, or how does a retail business, or how is a gold importing business, or whatever it might be,
Mm-hmm.
and you're trying to fit this new business into the form of the one that you're already familiar with. Now, the reason you're doing that is you're trying to save time.
Mm-hmm.
You don't want to spend hours pouring through the filings and meeting with the management team and visiting the operations, et cetera. And you want to race to the conclusion about whether this is a business that you'd be interested in owning or not owning. And I argue this is an error because you're biased to not see the things that make the business interesting, unique, or different. And those are probably much more relevant facts to find from an investment standpoint, rather than how is this similar to things that I already know.
Gotcha. Okay.
And then on the other side, there is your brain trying to make a narrative in noise. So stock prices go up or down, and I'm sure most people who, if they're investors, have experienced this. So you buy a stock and it starts going down, of course. So you think, what did I get wrong about this business? What didn't I know? What does the stock know that I don't know? What is it telling me? And in fact, sometimes stock prices just move around on absolutely nothing, or certainly no reason that's related to the long-term fundamentals of the business. Yet your brain is actually just programmed to try to find an explanation for why the stock's moving in the direction it is,
Sure.
which then causes you to behave in ways which are counterproductive.
I've heard that in context of like people being interviewed on Bloomberg or CNBC or something like that, an analyst or an expert or whoever that, you know, the interviewer will say, well, why did, XYZ stock, go up or down today? And they'll say, well, this is why, blah, blah, blah. And sometimes you could probably prima facie make an argument to say, the CEO went to jail or something, and that probably is causal, But, I heard someone else just kind of say, they have no idea. It's just totally, you really kind of, unless there is some kind of, really red flag event that, stuff just goes kind of up and down naturally, organically for whatever reason that more people buying or selling that day. So I really appreciate that. That's so true.
And then this one I had the most trouble with, or I've had the most diverse set of responses to, was around uncertainty. And this may harken back to my philosophy roots on some level. So my contention is that the amount of uncertainty in the future is constant. So it's never more uncertain or less uncertain. And as an investor, you're always dealing with the future. Like you're not investing for today. You're investing for things that you think are going to happen in 5 years, 10 years, I don't know, 2 years. But you're always at risk of things happening in the future that are different from what you think might be going on.
Okay.
And what I believe happens is that people conflate uncertainty in the present with uncertainty in the future, and that causes them to make investment errors. So let me try to flesh that out a little bit more.
Okay.
So when Russia invades Ukraine and oil prices go up and there's a pandemic, we believe things are uncertain. We don't know what's going to happen. But you never knew that these things were going to happen in advance, and you still don't know what's going to happen in the future. Mm-hmm. But what you do know is that, stock prices change. So if you are an investor, the perceived near-term uncertainty actually correlates with better times to buy stocks. Whereas if you think that you can't see what's happening in the future, and so you don't want to buy, I think that's a source of error. Mm-hmm. Simultaneously, if you think you have really good visibility, you're also fooling yourself. You have no more visibility into the future now at the end of the conclusion of the Russia-Ukraine hostilities or oil prices or interest rates, that you won't have any more visibility under those circumstances than you do under today's circumstances.
Yeah,
that's my idea. I don't know if it's articulating it very well.
Yeah, I mean, what it makes me think of, so let me see if a message is received. It makes me think of just sort of like gambling. I mean, the uncertainty of thinking, well, okay, the roulette wheel, it's going to land on red this time because last time it was black, or it's going to land on red this time because the last 5 times it landed on red, or a coin toss or a dice throw or anything along those lines. People, it maybe even harkens back to your point about, trying to look for patterns where there really aren't patterns. So, I think that's really a good point that it's almost a, I don't know if cliche is the right word, but it certainly seems to be like a dictum that, when things are in a panic or things are uncertain, that markets do go down, and that then becomes a buying opportunity when, good companies are on sale for a discount. Is that kind of the spirit or the philosophy of what you think about that with the conflating uncertainty?
If I add the idea that you shouldn't be trying to assess how you feel about future uncertainty during these periods, because when you're an investor, you should always be accepting that there's uncertainty. So your action is predicated on not knowing what's going to happen in the future. Nevertheless, you still need to make some kind of capital allocation decision. Even if you do nothing, it's still a decision.
Sure.
So my advice or my approach is to focus on things that I think are knowable or more knowable. Like, is this a good company? Is Nike going to be a strong brand in the future? Is Home Depot still going to be around and providing drills and nails and lumber to for home improvement projects 5 years from now. And when you focus on the things that you can know, you discount these unknowables. Whereas if you focus on large picture stressing type activities, you're less likely to make good decisions because you don't really know what's going to happen one way or another. So that's kind of the point, or trying to make the point.
Okay.
And it was interesting because in Val, this message did not get across very well. But in other cases, the reaction I've gotten from professional investors and others is like, John, the points you're saying is obvious. So I'm still not sure that I've done a great job either way. But I do think it's interesting in that we have to deal with uncertainty. That's part of the job as an investor. How do you approach a perception that things are more or less uncertain, and how do you change should you change your investment approach based on these kind of feelings? My contention is that you shouldn't. You should have an approach that doesn't change because you're fooling yourself.
So do you think the folks at Vail just didn't want to believe it? Could that be part of it?
I'm not sure I explained myself that well. I think so. One response I got was, well, right now the range of possible outcomes for an event like Russia invading Ukraine is much bigger than the range of possible outcomes for the future before we had this event. So therefore, I have to change my allocation to equities to account for this wider range of possibilities. And I'm not sure that I agree with that, because I would say before the invasion, that was still possible.
Right.
You just didn't know about it.
Yeah, that's what I was saying. Yeah,
so you're kind of reacting after the fact to something. The example I used in Val was Brexit, because the Brexit vote actually happened while we were there one year, and markets tanked, at the conference. And everyone was, uncertain what to do. We're all losing a lot of money, and as it turned out, the range of possible outcomes to occur as a result of Brexit was not that, climactic. It didn't cause the European Union to implode or the euro to dissolve or what have you, which is what people were thinking might occur. So that was kind of that was one of the response. Somebody else came, he said, well, John, I think when people say times are uncertain, what they're really just saying is times are bad. These are bad times. They're uncertain. We don't know what's going to happen. I was trying to make a little bit more sophisticated point about strategy approach from an investing standpoint. But that's it. And then lastly, I got another response, which was like, hey, well, if you were investing in Weimar Germany, whatever equities you owned was a disaster. Like, they all went to zero. So are you saying that, we should ignore things like that? And that's not quite what I'm saying. You still have to acknowledge what you think is likely to happen.
Right. Yeah, probabilistically speaking, I guess. So, well, and then does that then relate to your next one about being a news junkie? I mean, is there a point of with uncertainty that's, you talk about having to focus your time on knowables, and if there's certain kinds of knowables versus something that's uncertain, then those seem to be at odds with one another.
As investors, we have a limited amount of time, and there is an overwhelming amount of information, and there's a huge amount of potential outcomes. So that's where the kind of intellectual challenge becomes interesting, because you have to figure, what am I going to do to generate the greatest possible outcome with the limited resources that I have, while managing risk of things going wrong? And I think trying to read all the news and consume all of the the data that's out there is not the right approach. That's going to lead to an inability to make decisions. But I think there's a feeling, there's kind of a feeling as an equity analyst, I think kind of being raised as an equity analyst, like you need to know everything. Like that was, if the stock's down 2% because the chairman said something like, John, how did you not know that? Why weren't you listening to the presentation? So I think that's unhelpful. And then my last one was a little bit of a retort against another value investor idea, which I called the cabinet of curiosities. And so Seth Klarman, who I mentioned earlier, said that popular securities are almost never undervalued. Whatever the herd is by definition in favor, you can only find value in contrarian out of favor stocks. And while you can occasionally find value in out of favor, little hidden off stocks, you can also find really terrible companies that way. Simultaneously, it's just not true that widely followed companies can't be cheap. If we look at Meta and Google in the last year, Meta a year and a half ago was trading at $360. It went to $90, and now it's back at $300. So to argue that Meta wasn't trading at a discount and a value at $90, I think it was trading at a low double-digit PE, is just wrong. It was just wrong. The facts show that it was wrong. So this is one of the most heavily followed stocks out there, and it was clearly trading at an attractive price, as was Google and some of these other names. So the market frequently can give you opportunities. You don't need to go after obscure, tiny little companies that no one's heard of to find good value.
Got it. So I like all those. We'll get those put into the write-ups and stuff for the show. So with all these kinds of things, what are some of the tips for investors to avoid these kinds of errors?
Well, I mean, it's boring, but you have to do the work. And I think that you want to buy things that you can understand. This is not a unique idea.
Yeah.
I don't necessarily think you have to go the Peter Lynch route, which is to buy only or focus on businesses that you use as a customer.
Yeah.
But me personally, I avoid tech businesses that I find too difficult. If I can't really understand what the business does or why it has a competitive advantage, I won't invest in it. If you think about a business like Microsoft, okay, I mean, pretty much everybody's using computers, and unless you're a Mac fanatic, or even if you are a Mac fanatic, you're aware that Microsoft creates the operating system and the office software for virtually every computer in the world. And with a very limited amount of work, you can see that the margins that Microsoft achieves with this product are very high, and that the company generates a lot of cash. And so if you believe that the business is innovative and they're reinvesting that cash in an attractive way, so like, for example, to develop cloud computing or invest in generative AI, now you have a sense that, hey, this is a good company. It has a really strong position. It's really hard to imagine operating systems working on some other company's platform. Could happen, but unlikely, or certainly it's not going to happen overnight. And the business is really strong from a balance sheet and cash flow standpoint. And so as an individual investor, you could probably do all of that work. That's not that hard. And then a little bit more work to try to figure out if the stock is attractively priced relative to history. So I think with those kind of approaches, you can find businesses to own. Don't chase stocks that have moved up a lot. Don't listen to too much media. I think one thing we didn't talk about, but which I like to repeat, is that the media's incentive structure is to be a kind of a triggering machine. So like what they want to do is amplify whatever the most recent fear is, or whatever the thing that's going up the most is. And so this influence is pernicious in terms of how you want to orient yourself as an investor. So you could use the media to start as a starting point to find out about new stocks, but you need to do your own work, focus on long-term, own businesses you can understand, and whatever you do, don't sell when everyone's in a panic.
That's good. That's very good advice. So I know we're pushing on an hour and a half. I just have a couple of other just little maybe light things to talk about in generalities. Are there sources that you read or books that you recommend that are helpful either for investing and or in developing mental models or decision making that you would recommend to listeners?
So I already mentioned Fooled by Randomness, but I would argue the book that I find most interesting is Daniel Kahneman's Thinking Fast and Slow, which I read twice, which I almost never read any book twice. And that's not per se an investing book, although he talks about investing a lot in it. He's a psychologist, and I used to study philosophy of psychology, and we would distinguish philosophers from psychologists by saying that, well, psychologists actually go out and set up experiments and get data, and philosophers just mostly sit around and think about what might happen. So he's got some really great examples within that book about how our brains are fooled and processes that are happening that influence the way that we think about things and the behavior that we make without us even knowing. And I think that if you want to understand yourself and how you invest and avoid mistakes, you need to understand your own wiring. And I think this book is really powerful in helping to create a framework for understanding some of the things that you do or don't do without you even knowing it. So I would recommend that book. Let's see what else is. I would say those are my two favorite books: The Fooled by Randomness and this one.
Great, good. Yeah, I agree. Those are classics. So thank you for this time, John. For listeners that would like to know more about you and your work, getting on your newsletter list, what are some of the best ways to do so?
Well, you can sign up for my newsletter, which is free, on my website. It's www.quovadiscapital.com. That's all you have to do.
Okay, great. I'll put that in the show notes. So, John, I want to thank you so much for taking the time to be on and give us a glimpse of your world and your process. It's just really been fascinating, and I very much enjoyed it. Thank you so much.
Thank you so much for having me. I had a really great time.
Living a Life in Full is a production of Stout Media, a subsidiary of Gordian Knot, LLC. Assistant producer, Gracie Wong. Music, Dan O'Brien. Executive producer and host, Dr. Chris Stout. To learn more, stop by our website, A Life in Full, for show notes. And please recommend us to your friends and subscribe on your favorite platform. And as for the obligatory disclaimer, this podcast is for general information uses only and does not constitute the practice of psychology, medicine, nutrition, or other professional healthcare services, including the giving of medical or psychological advice. No doctor-patient relationship is formed. Lastly, and perhaps most importantly, I take conflicts of interest seriously. For all of my disclosures as well as show notes, please see livingalifeinfull.org/podcast and my LinkedIn profile. Thanks, and until next time.